look, if you hold it to maturity, you're going to lose money. So investors clearly are making a bet that there's going to be more investors piling into the bond space, driving up prices, so they're going to take some money there. And our currencies and volatility, they're just making another bet that way as well.
Well, it depends. If you expect more stimulus, i.e. lower rates, and we've got negative rates in, five countries across the world, then you still have a carry trade. So it's not just about bonds per se, it's about funding. And the main perception at the moment in time is that we're going to get even more liquidity and further policy stimulus across the world.
What's the most interesting sovereign bond space right now that you're seeing?
I actually think it's those that are already in the negative trap. So
Really?
Yes, absolutely. So in the case of German bunds and JGBs, you already mentioned 20 years in the Japanese government bond market just touching zero and going below. Well, we only have now 12% of the entire Japanese government bond market that is in positive territory. If that dips below, there's no choice but to look overseas. So that, to me, is one of the crystal clear elements about diversification and grabbing for yields globally.
Interesting. I mean, even if you look at the Australian space, people are pouring into Australian bills there. It's driving down yields. And despite all of these warnings, which S&P just confirmed moments ago, that it is diminishing its outlook for the Australian economy to negative now, down from stable, do you expect people to just kind of shrug that off and still go for it?
Well, let's draw some parallels. The UK. So we had last week a wave of downgrades by the rating agencies and negative outlooks. What was the impact? We had lower yields, again, same phrase, record levels. So this is not the driving factor. Certainly, we're still talking about investment-grade status. And when you talk about Australia, it still has one of the lowest, if not the lowest, public debt to percentage GDP within the OECD. So to me, it's not about ratings.
Okay, it's lower. I mean, it's the lowest. It's 37% GDP, right? Compare that to U.S.,
sure,
to Japan, 250%. Even if China is not a developing market, it's also 250%. But it's not the size. Many say it's the rate in which it's growing.
Well, yes, but then if you look in terms of valuations, so people talk about yields are very low. For example, in 10-year segment, it's now below 2%, a record low. But relative to other markets, it's actually a very generous, and it's a high-yielding market. So to me, there's a lot more compensation than just looking at rating differences between the countries.
Okay, when it comes to rates, call it for us. We went from 4 to 1 to maybe none for the Fed.
Right.
What do you think after tomorrow's jobs report?
Well, we're used to the phrase now, low for longer. It could be never for forever, right? Now, that might sound a bit extreme, but certainly over the proximity of the next, this year next, the market is really priced out the prospects of a further rate hike.
Yeah, maybe for a lot of people's lifetimes, at least.
Yeah, and certainly, and let's widen out the net, because it's not just about the US. The Fed themselves cite many references globally, whether it be Brexit, whether it be currency exchanges, whether it be China and economic slowdown, etc. Well, if you look in the proximity of ECB, BOJ, can you talk about rate hikes on any time horizon? No.
Yeah, but how sustainable is that for central banks to keep it at such record lows and maybe negative territory?
Well, unfortunately, there's no choice in the absence of governments picking up the baton. So it's still about liquidity. So to me, I agree, there is maybe some other emphasis of other policymakers need to step in, but in the absence of that, it's central banks. They have no choice, in particular the UK, and we've seen that. And indeed, next week, highly, highly likely that Bank of England joins the fray for the first time since 2012, this global phenomenon of easing rates.